issues will be there. Okay. Now, NCI at fair value. So I am going with this question. This question covers everything regarding deferred consideration and impairment of goodwill, everything. Okay, let's see. The draft statements of financial position of Ping and Pong Company on 30th June 2008 were as follows. This is the statement given to you. This is the statement of financial position. They have given you the property, plant and equipment. The Ping Company invested in Pong Company. They have taken 20,000, they bought 20,000 shares of Pong Company at this much cost. Okay. You already know that we need to cancel the investment done by the parent and the share capital of the subsidiary. That we need to cancel. You already know this fact very clearly. Okay. Then they have given the inventory. Then they have given the intercompany transactions owed by Ping Company. So who is Ping? Ping is the parent. And who is Pong? The subsidiary. Please participate, all of you. So owed by, that means the Ping Company is supposed to receive $10,000 from Pong Company as a receivable. That is, they have an intercompany transaction. That means they are supposed to receive some money from the subsidiary, the Pong Company. Okay.
Yes, sir.
Yeah, just a second. Yeah. So actually, I'm sorry. This is like this is Pong Company. Yeah. This is like who is buying whom? Acha. Sorry. This is like Pong Company. Pong Company is supposed to receive from Ping Company. Okay. Because in the books of Pong Company, this is a asset, receivable. Receivables are given, but I can say this is a current asset. It is also a kind of receivable for the subsidiary company, Pong Company. So owed by Ping Company is how much to Pong Company? $10,000. That means Pong Company is supposed to receive $10,000 from Ping Company, and Ping Company is supposed to pay how much to Pong Company? Please tell me.
10,000.
$8,000.
8,000.
Yeah. So Pong Company is supposed to receive 10,000 from Ping, and Ping is supposed to make a payment of 8,000 to Pong.
8,000.
So this is very clear. Receivables are given, cash is given, ordinary shares of $1, the parent's share capital, subsidiary share capital, revaluation surplus, retained earnings, and also the trade payables. So this is the question all about. Once you can have a look through this, then I'll go for the adjustments and the solution part. See, one thing you should understand, whenever there is a case of acquisition and additional payment made by the parent to subsidiary, definitely their goodwill calculation will come into picture. Okay, that you should always remember. And Rajeshwari, can you tell me how to calculate goodwill? Hello?
Yes, sir.
Rajeshwari, how to calculate goodwill? First?
Sir, goodwill first we will take the investments like purchase consideration.
Consideration transferred.
Next we will add it NCI at acquisitions.
Yeah, if at all NCI is there. Okay.
Next, like if it is like fair value method, then we will deduct the fair value of the net assets of the subsidiary.
Okay.
Then we will receive the goodwill on acquisitions.
If it is not the fair value method, what you're saying then?
Proportion of net assets method.
Proportion of net assets
Yes, sir.
or net assets that is represented by equity.
Sir, two methods are there, sir. Here, if like fair value method is adopted.
Leave it. Leave that fair value method. I'm asking consideration transferred less add the non-controlling interest and deduct the net assets represented by equity.
Subsidy.
Equity is nothing but share capital and retained earnings. Correct? Hello?
Yes, sir. Sir, actually,
Actually,
sir,
what?
actually, I'm comfortable with the other formats, sir, so I'm getting a little bit confused
No,
in
you
this.
tell that format. I don't have any problem.
I have sent now, sir.
How did you say you are saying fair value method? What about everything is given in cost then? You won't take cost?
Sir, not here, sir. Like in the working note too, we will do now, sir. Net assets of subsidiary. First, we will take share capital, and then we will add the share
That is what
premium
I'm
retained.
saying. That is what I'm saying here. Now you should deduct here. That is what I'm saying. What am I saying here?
So like this all we do in this working note too, sir.
But
That's
yeah,
why.
working notes, let it be then. Goodwill calculation is a working note only, na. I'm also doing the working notes. I'm not
Yes,
doing
sir.
anything fair. I'm in consolidation. We won't show all this thing. Now we'll do in working notes only.
Yes, sir.
Okay, no problem. For this,
Five notes.
yeah, for this question, you try to guide me how to calculate the goodwill. Okay. Now,
Okay, sir.
then we have the like. Let us go with the adjustment part. So the parent acquired its investment in the subsidiary on 1st July 2007, when the retained earnings of the subsidiary stood at 6,000. That is, what is this subsidiary, Rajeshwari? What is this retained earnings?
The retained earnings on acquisition.
Yeah,
Of
can I
the-
say this is pre-acquisition retained earnings?
Yes, sir.
Yeah. So what is your
Pre-acquisition.
post-acquisition retained earnings then?
Of the parent, it is 26,000. Subsidiary 28,000, sir.
How come? For parent it is this much, no problem. For subsidiary it is this much, no problem. I'm asking, if the pre-acquisition retained earnings is 6,000, then what is the post-acquisition retained earnings in the subsidiary?
Post acquisition. So subsidiary.
Maybe 0.
This 28,000, 6,000. If you remove this,
28.
if you remove this
Achha.
pre-acquisition retained earnings,
22,000.
the leftover is post-acquisition. So why are you not getting this? Because
Okay.
you're not going through any videos, not solving any past questions, and not paying any heed to any videos and points. That's the problem here. Your speed would increase only if you practice. Now, so here till here everything is all right. Okay. The agreed consideration was 30,000 in cash and a further $10,000 on 1st July 2009. So this is when did the parent acquire the subsidiary? Ping acquired the Pong, Rajeshwari, on which date?
They were acquired on 1st July 2017.
And what they are agreeing to pay after, like they are agreeing to pay after 2 years. Am I right?
Yes.
Excuse me. Excuse me.
Yes, sir.
Hello? Yes, sorry. So, hello? Yeah. So, agreed consideration was $30,000. So, the parent Ping will pay how much to acquire Pong? $30,000. And how much they are going to pay further? $10,000. Rajeshwari, when they are going to pay this $10,000? Hello?
Yes, sir.
After 2 years.
After 2 years, okay? So 2000, so 2009 they're going to pay. So can I, what kind of case this is? What kind of problem it is? When they pay after 2
Kind
years,
of.
what am I? Hello?
Nothing, sir.
Yeah, what is this? What kind of, what case is this? Can I say this is deferred consideration case?
Yes, sir.
All of you, please. Yes, Meghna, is this deferred consideration or not?
Deferred consideration.
Yeah.
Yes, sir.
Yes, sir. Yes, sir.
Yeah. Now, so Ping companies, so whenever you have a deferred consideration case, they will give you cost of capital. So Rajeshwari, why will they give you cost of capital here? See, this is for sake of all of you. I'm not targeting anyone. In fact, there is no point of me targeting. The only point what I want to know is your conceptual clarity, so that it will help me out. So don't think that I'm asking questions to one student only. If someone knows, they can also answer. Come on. Why this cost of capital is given here, Rajeshwari?
To calculate the present value.
Yes. So this,
Yes, sir.
since there is a deferred consideration case, the cost of capital will be given to find out the present value. Okay? Because we have to show the 10,000 what we are going to pay in the future. That 10,000 what value it is today, that we have to show. Okay? And there will be a concept of unwinding of discount. What is that? What is this unwinding of discount? I'll explain you while doing the question. Yesterday I have explained you very clearly what is that. That is nothing but the finance cost. Why? When 10,000 which you will be paying after 2 years, you will be finding the present value of that today. So can anyone tell me what is the present value of this 10,000 today? Yes, any of the students? Just calculate and tell me,
10,000 by 1 plus
please.
7,000. 10,000 by 1 plus 7% power 2.
Our-
1 plus r to the power of n.
Tell me what is the answer?
8,730.
8,730.
34.
34. So now,
34, sir.
yeah. So 10,000 is what you're going to pay in the future. Of that, the present value today is this. So what is the finance cost? That means this is what is today, na? It will become this much after 2 years. So for this current year, your finance cost will be what? What will be your current year's finance cost?
8,730.
Interest amount.
Yeah, interest amount, 8,734. What is the answer? Yes,
1,266.
but this is for 2 years. You have to do for 1 year. So what is the answer by 2?
612.
So this is this
612.
year's interest, because you are making the statement for this current year. Okay. So this is the way you have to understand the question. Yeah. Now, next point. So till here I have made everything clear to you. You can also check the working notes. Whatever it is. You can check the working notes here till here. If anyone has got any doubts, they can ask me immediately. Yes.
So that is 633, sir, not 602.
It's 33. What is that? This
No,
one.
sir, 612.
So maybe you have not, this is not correct maybe. Please check it once. Maybe you have done some mistake. Let's see. $10,000.
So 10,000 into 1 divided by 1.07 is 9,300. 9,345.7
No, I
minus
want for 2 years
870.
now, not for 1 year.
So first year minus total finance cost, na sir.
Just a second, just a second. Yeah, please tell me, what did you say? So 8,
So first year present value minus finance cost, we get that now.
yeah, okay. So what is happening? This is the this is the consideration. No, where's that? 10,000, okay. So 10,000 into 1 by 1.07 whole square is this. This is the total present value. Okay. Now, for you, like 10,000, whatever this 10,000 you're going to pay after 1 year, correct? After 2 years. That is, you're going to pay in 2019. So I'm sorry, like there is small mistake here happened. The mistake is not that big mistake, but small mistake. So this is all right. This 10,000 you're going to pay after 2 years. I agree. But we need to find out the finance cost for this current year. So the finance cost for this current year would be the present value of 10,000 this year minus what?
8,734.
Yeah, this 10,000 you're going to pay after 2 years. I agree. But this is the after 2 years present value, correct? This is
Yes, sir.
Yes, sir.
this 8,734 you got when you considered 2 years discounting. But I want the current year's discounting of this 10,000, correct?
Yes, sir.
10,000 divided by 1.0. This is what if I pay the next year. If I pay this 10,000 next year, suppose this 10,000, this is 2017. You are paying in the year 2019. So for this 10,000, what you are paying in the year 2019, the present value will be for 2 years. That is 2018 and 17. But if I suppose pay it in 2018 and I'm making the books for 2017, I need to find out the present value for this year. So 10,000 divided by 1.07 whole power 1 minus 8,734, which is exactly the present value as on this date. So will I get the like what is this? Can you tell me what is the value of this? 10,000 by 1.07?
9,346.
9,346 minus 8,734. If you do 612 is what you get. Okay.
Yes, sir.
This is the wrong treatment. I'm just sorry for this. So this is your finance cost. Please check this computation, then I'll go for the goodwill calculation. Okay. Now, let's do the goodwill calculation. So consideration transferred. So what is the consideration transferred totally? 30,000 plus the 8,734, which is nothing but the present value of 10,000 deferred consideration in the year 2019. Correct or wrong?
Yes, sir.
Yeah.
Yes, sir.
Yes, sir, correct.
This is what? Then your fair value of NCI is also given in the question. Not given, we can find out. Okay, they have given it very clearly. Good. And this is the
9,000.
yeah. Net assets acquired represented by all this equity, revaluation gain, retained earnings, and the like intangible asset brand name. We will see what is this. So Pong company has an internally developed brand name. See, internally developed brand name or goodwill or all these things we won't show in the books. Only the acquired things will be shown. But the question says Pong company has an internally developed brand name, Pongo. The name is Pongo. But it has a value, it seems, of how much? $5,000. Correct or wrong?
5,000.
Yeah, at the date of
Yes, sir.
acquisition. So there have been no changes in the share capital or revaluation surplus of Pong since that date. Now, so please tell me, all of you, Here, what did you take? Pre-acquisition retained earnings, correct? So you should take pre-acquisition intangible asset value also. This is a new, a very new kind, because you are acquiring all the assets of that company. So whatever the assets you are acquiring of that company, that is nothing but the net assets. Net assets is nothing but total of assets minus total of liabilities. So what will be left over? The ordinary share capital, that is the equity, and the retained earnings on acquisition, that is also a part of equity. Okay, and this equity has retained earnings, revaluation gain, everything. And also they are paying additional amount for acquiring that company, that also they will be adding here. So the total amount here is, for that company, the total valuation is coming to how much? 41,000. So goodwill is how much? 6,734. All of you please calculate.
6,734.
Yeah, all of you please calculate this. Hello? Rajeshwari, you are having network issues, it seems again. All of you calculated?
Yes, sir.
Okay. Shall I move forward then?
Yes, sir, done.
So can you explain once again, sir? I just got disconnected.
Rajeshwari, you should
Sorry,
check
sir.
your connection, please, because again and again, if I repeat and go ahead like that, it waste a lot of time. Barely I am not able to finish one question also in a class. So like 30,000 plus 8,734 fair value of NCI, we will add them, and ordinary share cap, because net assets, whatever you are acquiring of that company, net assets acquired represented by ordinary share capital, revaluation surplus, retained earnings on acquisition. Why? Because I told you what is net assets, total of assets minus total of liabilities. And you are also acquiring their brand name. So when you are acquiring that brand name, that will also be coming in this total, na? All of you please tell me.
Yes, sir. Yes, sir.
The brand name is acquired by the parent, na? So that will also be included in this. Actually, the brand name on the date of acquisition is what that came into picture. Okay. Why it came into picture? I'm telling you again and again. Internally generated intangible assets cannot be accounted in the books of accounts. Only on the date of acquisition, they said, we have a brand name called Pongo. To acquire this, you need to pay us $5,000. All of you, please tell me. All of you, please tell me, did you understand?
Yes, sir.
Yes, sir.
Yes, sir.
Let's move forward. So this is what it is done. You got the goodwill. This goodwill will be showing in the consolidated balance sheet under intangible assets. Okay. Let's move forward now. Now, so this is done, and okay. At June 30, Pong Company invoiced Ping Company for goods of value 2,000, and Ping Company has sent payment in full, but this has not been received by Pong Company. So this is a receivable. This also will adjust. Need not worry. So this is the revaluation surplus, which is already given in the question. So you need not worry about that. Where is the revaluation gain? This is the group revaluation surplus. Because the subsidiaries revaluation surplus of 5,000 already has been taken in the goodwill calculation. Okay. Now, this is the retained earnings of the Pong Company, the subsidiary. And out of that pre-acquisition retained earnings, we will remove. We will get the post-acquisition retained earnings. This post-acquisition retained earnings have to be apportioned amongst the parent and NCI or not, all of you?
Yes, sir.
This is the current,
Yes, sir.
this is the current year profit now. After the acquisition of subsidiary, this is the profit what the company, subsidiary company has earned. This will be apportioned amongst the parent and NCI based upon their shareholding. Now, what is the shareholding of parent in the company? Anyone can tell me? 20,000 divided by 30,000. How much can you tell me this is?
0.66.
0.66.
Yes, sir.
Just a second. No, sorry. Extremely sorry. They paid 30,000. The share capital is 25,000. Okay. 20,000 by 25,000 is
0.8.
yeah. Actually, like the parent paid 30,000 to subsidiary. We cannot take on this now. We can take on the share capital of the subsidiary because in this we are looking the proportion of parent and NCI. I really forgot that. Forgot in the sense I don't know why, like while writing on the screen, I'm after seeing all this untidy thing, I'm getting kind of confusion here. So this is 80% is what the parents share and 20% is NCI.
Subsidiary.
Not subsidiary, NCI. NCI share in subsidiary. Now, so this 22,000 of that 80% will go to parent and rest of the 20% will go to whom?
NCI.
NCI. So the fair value of NCI is 9,000 and the share of NCI is 4,400. And the
Madhu's
4,400.
hello, anyone got any doubt? Hello.
No, sir, clear.
Yeah. So one thing you should remember. You see this. You are not making income statement. This question is not about making income statement. This question is all about statement of financial position. So the finance cost, which you will be kind of showing in the P&L, will again come to which account?
Retained earnings.
That means the profits will be transferred to this, and there the finance cost adjustment should have been done. Since we are not making the P&L account, we'll adjust it here. Okay. So this finance cost is incurred by whom? Why? Because who is going to make the payment in the future? The parent.
Parent.
Yeah, who is going to pay the interest? The parent. So from the retained earnings of the parent, we will remove the finance cost and we will add the income from investment to them. That is the share of profits, what they got from the subsidiary. This is the retained earnings of the parent, now of the group. Okay. Now, NCI we calculated. It was such a simple question. I don't know what was the problem and you did not do as a homework. Okay. Now, see, Pong Company, last and final point. Pong Company has a cash in transit of this much. What is this cash in transit? The cash has been sent by the, who is making the payment here as per the question? Ping Company, correct? Yeah. So Pong Company had invoiced Ping Company for goods to the value of 2,000 and Ping Company has sent the payment, but they did not receive. So when the payment is still to be received or due to be received, that will be termed as cash in transit. So Pong Company has a cash in transit of this, which would be added to cash and deducted from the amount owed by Ping Company. That means since the Ping Company's liability was some X amount, out of that they made a payment of 2,000. So that liability of 2,000 will be deducted and that will be added to the cash account of or cash balance of the subsidiary, that is the Pong Company. Okay. So clearing all these things, one more intercompany adjustment is there. We will do that. And then you can do the consolidation part. So you are seeing this 2,000 cash in the group. All of you, please tell me. Hello.
Yes.
Yes, sir.
Are you seeing this 2,000 cash, which was cash in transit, correct?
Yes, sir.
Yes, sir.
And now let's also do the cancellation part. So Ping owed by Ping Company is 10,000 and here 8,000. So owed to Pong Company. So Pong Company is supposed to make a payment of this much and they are supposed to receive this much. So 8,000 cancelled and 2,000 they have added in the cash account because they made the payment. Okay, done. So please do the a consolidation part, and there we are. You should add the current, you should add the non-current assets, you should add the goodwill, the brand name, and then again inventories and all the intercompany adjustments you have to do, retained earnings of the parent, revaluation surplus already explained to you, parents capital, and also from the liability part you should do the consolidation. So this completes the total question. I don't think there was any problem with this. So have a look through this question. If you have got any doubts, you can ask me. Okay, now so did you do this question yesterday? I gave some, this question also as homework. Huh? All of you please tell me 6.3. Hello. Hello.
Yes, sir.
Did I give this as homework? I'm asking, did I give